The last week has been absolutely bonkers for markets all around the world. Trump's trade war has gone bonanza and it's creating havoc everywhere you look. In this video, I'm going to unpack what it all means for Australian property, and in particular, I'm going to go through interest rates here in Australia. I'm going to release one crazy prediction here. Interest rates that begin with a 4 handle will be coming to Australia very, very soon. Let's go. Okay, so let's begin by explaining why is the RBA going to cut? And more importantly, why are they going to cut interest rates by a lot? This all comes down to strategy. And the RBA's interest rate strategy right now is not fit for purpose. You see, they've set interest rates for an environment that was trying to slow the economy down. But now circumstances have changed, and as a result, the RBA are about to change gears too. So let's unpack exactly what type of strategies central banks have. There's really 3 separate approaches a central bank can take. It starts here. They can set interest rates really, really low, and that will promote the economy to go forward. That's called an easing cycle with the RBA and central banks. That's setting interest rates very low. You can have neutral interest rates. That is letting the economy do its thing, no longer trying to drag it back or push it forward, and just leaving the economy to do its thing and setting interest rates at a level that supports economic activity and doesn't create a drag on it. And then there's the third part, which is where we're at the moment, which is restrictive interest rate settings. These are interest rate settings purposely designed by the central bank to slow the economy down. And the RBA does this when inflation is too high. Now, we haven't had too many periods of these restrictive interest rate settings, but we are in one now. To get inflation back down from those 7% crazy rates where they were post-COVID, they've had to really tighten interest rates and move us into a category where they need to slow the economy down a lot. We've talked a lot about that, and I'm sure you would have heard of that story before too. But now, that strategy is no longer correct. In fact, that strategy is also going to the opposite direction of where it actually should be. Inflation is back where the RBA need it to be. The economy is growing slower than the RBA typically like, and all of these changes mean that the economy is going to grow even slower than the RBA expect. Unemployment is doing fairly well, but there is a bit more risk attached to that, especially with a China slowdown coming in. So, why do we have interest rates setting at the restrictive policy settings when you have this new world order that we have right now? And that is why markets have completely flipped around and the expectations of interest rates have changed dramatically in the last couple of weeks. Effectively, everyone is suggesting, all the economists have done a little backflip and said, hey, there's new information now. The RBA shouldn't be out here in the red. In fact, they've got to pull it all the way around, steer that ship, spin it all around very, very quickly, and push it into the green fairly soon. There's a couple little measurements to actually explain this too. Here, I've got this chart that shows the real cash rate. A little bit of an economics jargon term here, but this means the level of interest rates that is above or below the inflation rate. If you have interest rates higher than the inflation rate, you're probably suggesting that the cash rate is really, really tight and really, really restrictive. And that's exactly where we are right now. And if you look at this chart, from 2015 onwards, up until recently, we've had a real cash rate that is either at 0 or negative. But right now, we've got a pretty large real cash rate in place of around 1.3%. That means interest rates are about 1.3% above where inflation actually is, depending on the inflation measurement you use. So that is suggesting we are way too tight, and history tells us that to get to the normal sort of neutral level, you need to bring that down to around 0, which means a cash rate of around 2.6%. Exactly what NAB and Westpac are predicting right now. Okay, so here we have expectations of interest rates over every single month over the next couple of years. And you could see that market expectations of interest rates in the next month or two suggest a big drop down. Now, the country's biggest economists are predicting a double rate cut in the next RBA rate meeting. And on top of that, NAB are expecting a double rate cut in May, followed by another rate cut in July, and another rate cut in August, and another rate cut in November, and another one next year in February. That's a whole lot of rate cuts as the RBA is steering the ship straight from aggressive, tight interest rate settings back to an easing cycle fairly quickly. And some banks are even saying that they might have to move quicker than that because of all the uncertainties that are taking place at the moment. And a quick little recap in case you haven't checked out this podcast. What is actually happening with the trade war and why is Australia impacted so much? The real story here is Australia is connected to China. China buys Australia's exports and China is going to experience some level of slowdown because it produces a whole lot of stuff and it sells it to America. Right now, America's saying, no more. You cannot sell your stuff to me. That is the brinkmanship that the two biggest economies in the world are at right now as we speak. China, a big producer, can no longer sell to America. That has some positive impacts on Australia in some ways. China's going to have a stockpile of stuff. You can just imagine it. You know those MG cars and all those cars that's coming out from China at the moment? They sell all around the world. They can't sell them to America, but they're still producing them. So it likely means that there's going to be some more deflationary impacts here in Australia as China starts finding a way to offload all of the products that they make to other countries. Australia may see some deflationary benefits from this. Meanwhile, in America, they may see some inflationary impacts associated with not being able to buy things from China directly. But there's another impact here too. Australia exports a lot of things to China, and without being able to access their market as much, because they are slowing down, we'll have less money to spend, and as a result, we'll buy less of our stuff. It does mean that our economy could slow too. So there's a whole range of impacts happening at the moment, and it is quite hard to work out exactly what will happen on aggregate. You'll have some things do really well, you have some things do quite badly, and overall, you have a whole load of uncertainty. The one thing that you can bank on, and the one thing that does impact property markets far more than what's going on in America and what's going on in China, is the interest rate Aussies pay on their mortgage. It's the amount of debt that they can borrow, and all of this is about to go down. And here's the last little golden nugget for you. For those that have stuck around and followed me on this journey to produce content, thank you so much. If you could do me a quick little favor, hit that subscribe button if you haven't already done so. The last little golden nugget is interest rates with a 4 handle are on the horizon very soon. I'm furiously going on my computer here and going, refresh, email, refresh. Is there going to be a cut to fixed rates around the corner? This morning, I got one from one of the country's banks that I've used in this report a lot, NAB, who have cut their fixed rates a little bit, but it's still well into the mid-5 territories. I am expecting a fixed rate offer from someone in the marketplace that wants to gobble up their competition pretty soon with a 4 handle in front of it. I'm thinking 4.99% is on the horizon. And the reason why is fixed rates are tied to the ability of banks to purchase bonds, and it's tied to this market in particular. And this market has come down fairly dramatically recently. If you take a look here, here's the 3-month Australian 2-year bond rate, and it's currently sitting at 3.23%. Now, 6 or 7 months ago, this actually fell from somewhere around 4% all the way down to about 3.6%. And at the time, a couple banks came out with fixed rate offers in the early to mid 5 category. So 5.39% was a common interest rate that you can get. You can still get that today as well. But now you have this same market down to 3.23. When you add in the cost of funds and the bank spreads to it, add in 1.5% for all the bank costs in there, you're starting to get to that high 4% category rate. So if this stays in around here, then you can expect interest rates with a 4 handle pretty soon. The Australian 2-year bond curve is where fixed rate markets are set, and it has come down. It is something to watch very closely if you wanted to know what will happen to interest rates very soon. This is big news. It is a dramatic change in a very short time period, and as a result, markets will completely flip. I'm going to do something pretty crazy right now. I am going to go through every single market across Australia and unpack exactly how this new information, how this trade war, how interest rate settings, how our ability to export and import goods from countries around the world, and how our markets that are exposed to the US will change. Because the property market is about to change, and you need to know exactly why, what, and how, so you can make better financial decisions.